So, hello everyone. Am I audible to everyone?
Hi Neha. Yes,
Hi.
you are.
Yeah, hope
Yes.
we do not have any further technical issues now in this during this program. So, welcome to today's session on accounting principles. So, before we begin the session, let's have few ground rules. This is a long session, being a long session, 4-hour session. We'll have adequate breaks in the session, but for that, I would request everyone to be on mute during the session, and only, we'll have adequate time for the Q&A. Please park your questions, and we'll give that time where before going to the break, we'll try and have that adequate time to answer your questions on that. Any clarifications you can use in the chat window to post your question to me, and accordingly, I will answered them, during the session. At any given point in time, if you feel that the pace of session is high, please you feel free to, have further clarifications from me, and, just intimate through the chat box. Please use chat box as frequently as you wish. So let's start. In this session, we'll be covering following areas: the accounting process. We'll learn about accounting process, what is the use of accounting, what is the importance of accounts, what are the various terminologies that we use in accounting concept, qualities of the accounting information, conflict of interest, managerial types of accounts, managerial financial accounts, so on and so forth. Then at the end of the session, we'll walk through we'll have some walkthrough session on the Hindalco's financial statements. Okay.
Okay, and you will cover all this in this session on?
Yes.
Okay, thank you.
So now let's begin. Introduction to accounting. So let me start by asking you, what do you understand by accounting? What is your idea of what is accounts, and why is accounting required? If I may have an answer from you. Okay. So let's try and make it more interactive. Let's have the whatever answers you get in your mind, whatever you can think of. Please please post it in the chat box so that I can understand what you're getting, what you're not getting. So if we'll make this interactive, this is a long theoretical session. If we'll make this interactive, only then we'll be able to understand that I'll be able to provide you much clear clarity on the concepts and whatever we are going through in this session. So yes, can I understand what is your idea of what accounting is and why it is required? Right, accounting is required for record, right? So accounting is basically yes, to keep the record of every monetary transaction, very right, in chronological order, right? For analysis, true that. Yes. So accounting means, keeping a record of every financial transaction that is there in the business. So accounting means keeping the track. Why is accounting required? Accounting is required, so that we can have a business can keep a control of the income and expenditure. Moreover, there are statutory compliances around, on maintaining the accounts. It provides us the information on where our business stands and what needs to be done next to maintain to reach to the level that the management and everybody is targeting. Who needs accounting? Accounting is required by all type of users, be it internal user or the external users for the business. Internal users may be the management, the stakeholders, and external users will be your investors, your customers. Those people, they are all sort of people who are interested in some in a business's performance. Accounting is required on a periodical basis. You have to present the periodical accounts. You have to maintain and present the periodical accounts to all sort of interested parties for your business. Moving next. What is the meaning of accounting? So accounting is process of recording, classifying, summarizing, and analyzing, interpreting the financial transaction of the business for the benefit of management and those interested parties who are interested in the business. So like we have discussed earlier, so this is the all type of transactions which can be quantified, which can be measured in money terms, which can be which has a financial implication. All those sort of transactions, when they are recorded, classified into what sort of an expense it is, what sort of a transaction it is, then and finally summarizing and presenting it in some form of a statement, in a form of a financial statement, becomes your accounting. This entire process of capturing this financial information, and then from recording to analyzing to interpreting and then to presenting, this becomes part of accounting. Purpose of accounting? The main purpose of accounting is to maintain the record of the financial transactions, then to present the picture of what the complete picture of the from the business's standpoint, and then it is majorly required for the statutory requirements. According to the various laws of the state, you are required to maintain the accounts for your taxation purposes, for every other purposes. Moreover, accounting is a business language. We've heard people using various specific technical accounting terminology. This is the terminology which is which is used in the business to understand some to understand the particular business nature and the business transactions. So this is accounts is termed as the language of business. Need of accounting. Why do we need it? The answer is very, very simple, I think. Only people are interested to know that how well an organization has performed and where does it stand today, so that they can analyze and project what can be the future tomorrow. Okay, so how well has the organization performed? Which the financial statements will give us the answer. The financial statements, that is balance sheet and the P&L, profit and loss account of the business, will give us how well an organization has performed. Balance sheet is the statement of the assets and liabilities of an organization, and profit and loss account will surely present that how has what has the operations of a business led to, either profit or loss during a particular period. So this says that this gives us an answer that how is organization performing, and today the balance sheet presents us that where does it stand today over the entire years of operations that has happened during the life of the business. Accounting process. Accounting process begins with identification of a transaction. Any transaction which involves money, which has an impact and can be measured in money terms for a business, becomes a transaction. So that identification of a transaction, then recording that transaction, recording and classifying, that becomes the part of recording, step 2. Then communicating. How do you communicate those sort of transactions? You communicate when you prepare the accounting reports. We prepare accounting reports, and so as to we can communicate the transactions, the performance to the users, whatever internal, external we have. Okay, and then analyze and interpret for the users. So this communication will help us to give us the analysis to the various users. Who uses accounts? Accounts are used by shareholders, customers, suppliers, tax authorities, lenders, employees, every sort of, you can see whole lot of people who are interested in the accounting information for a particular organization. This is the list of people who are interested in accounts and the accounting information for a particular business. So looking at the accounts or a financial statement, what sort of questions will internal or external user ask? So internal users will generally internal user ask what what do we have sufficient cash to pay, or can we afford to pay, can we afford to have incremental salaries, can we afford to pay, to spend some extra on marketing or whatever type of, how can we increase the profitability. So all these sort of answers they look for when internal users try and look into the accounting information. If I may ask you, what if you are looking at an accounting information or account statement, or if I may say, what sort of questions are you may really think that you will ask after looking at an accounting statement of a particular organization or the business? What sort of questions come to your mind apart from the four that are mentioned here? What do you think you can ask?
Hi, like how to cope up with the situation, like if they'll occur a loss or something like that, that I can ask.
Yes, you can definitely look at
Hello?
the, and yes,
Yeah.
yeah, sure. You can definitely look at the loss.
There,
Sure. Continue.
sorry. Actually, like there is a risk analysis, so I'll ask like how analysis have been done in your company. So like that, I can ask the questions. Like I can see from the financial performance, but there are some difference between, like there are 2-3 departments are there, no?
Yeah. So
So
okay.
so we
You
can ask from there.
I'll
Like,
summarize it for you. So you will look at the financial performance of an organization from the of a business from the picture. Then you can probably, you mean to say you will strategize. You can strategize. Yeah. So basically,
yes.
if you look at the if I will typically if you look at the income statement of a business, you can generally, if you think that there are profits, you can surely arrive at a decision that we can spend somewhere here. How, if we have to increase our profitability, we have to increase our sales, how much it gives us an assurance that if we have that margin, that we can go continue and strategize spending on marketing front. If we can go and be more kind to how much dividend we can pay to our stakeholders, so on and so forth. Okay, so this what sort of expenditures we can increase to grow, and in which direction we can go. Definitely this will help us to do. So is there sufficient cash to pay the bills? Can we afford to pay employees the salary next year or this year? What is the cost of manufacturing? Obviously we can look at, okay, what is the cost that we are incurring to make the products available in the market, and if we can be more competitive, if we can reduce the cost, if we can so this all sort of strategizing, this financial statements help us to do. External users are more interested in the question like, is the company earning satisfactory income because they have invested in it? Probably they are the new investors, or they are target investors. So they'll always be interested in that, if there is looking at that, if this company is performing, operating well, if the company will be able to pay their debts on time, how does a company's size and profitability when it is measured with the competition, where does company stand in the market, and what do we do if they catch us? Okay, so how do we come to them, and can we really bring some value add to this company? So the external users will always look at the financial position, and they can have the question and answer questions to after looking at the financial statement in this context. So talking about the financial statements, so when we have all sort of users, internal and external, all sort of users, when they are, there is mixed sort of users to look at the financial statements. So there arises a situation which is called the conflict of interest. So by the very, name of this topic, conflict of interest, it says that we can understand that internal users and external users, they will have different interests in looking at the financial statement, while stakeholders, while the owners, the proprietors of a business would want to have a balance sheet which shows a really promising or a really good picture on the accounts of the business, of the financial health of the business. The somebody who's external, who's investor, he would always be interested that if this picture is a real one, if this actually is fair, if this whatever disclosures are coming, are they actually true, or are there any some hidden truth about the business. So whenever a financial statement is put across to various stakeholders, internal ones would like to see it as a, they would do everything to make it more bright, the financial statement more glowing. But external ones will always have a sense of what should I call, a sense of insecurity, or they would like to have a fair picture. They would always like to have that work, they would always like to have a conservative view on the financial statement, so that that their interests are also secured. So coming to accounting. So accounting, basically there are accounting rules, there are rules to do the accounting. So accounting rules basically depends upon what type of accounts we are dealing with, what type of an account we are talking about. So accounts are basically divided into two sort of two types: personal account and impersonal accounts. So personal account, by the very name, which we can say, the accounts which deal with a person, an entity, a business, that has an individual legal existence, they are called personal accounts. And impersonal accounts, they are further divided into real and nominal accounts. So let's get into the detail. What are personal accounts? So accounts which represent persons or organizations, they are called personal accounts. So all customer, any debtor, any organization, any business that a business is dealing with, they are all those accounts. The account of those individual entities will become the nature of personal, will be categorized as personal accounts. Impersonal accounts, personal account, we have an example of an organization, XYZ Private Limited. So the rule of accounting for any personal account is that whenever there is a transaction, you have to, there are two sides of accounting. One is debit and one is credit, which we all know. So debit, the receiver, whoever receives out of, there is a transaction between two persons. So then the receiver will be debited and the giver will be credited. So if we look at this particular example here, if Mr. X paid 50 rupees to XYZ Private Limited, both are personal accounts right now because they are both individual legal entity. So Mr. X paid rupees 50 to XYZ Private Limited company by check. So what sort of an entry, an accounting entry will it create? It will create XYZ, because XYZ is the receiver here. So XYZ Private Limited will get debited by 50 rupees, and bank account will get credited because it has been paid by check. XYZ Private Limited will get, bank account will get credited by 50 rupees because it is the giver. Bank account of Mr. X, it's the giver and it will get credited. I hope this is going fine. You are going fine with the pace and you are getting clear here. Okay.
Yes.
So let's move on to the next. Real accounts. So real accounts which are tangible in nature. So when we are talking about now impersonal accounts, we are talking about the real accounts, the real accounts, and the, just a second, please. Yes. So in this impersonal accounts, now let's begin with the real accounts. So real accounts are those accounts which are tangible in nature. So basically the company's assets and liabilities. Assets and liabilities, they are categorized as real accounts. They are these assets and liabilities, they are carried forward, and they do not get closed at the year end. So they are year on the though accounts are prepared year on year, so the assets and the liability of any business, they are carried forward. That means they present the actual picture, the actual balances since inception of the business as on date when the statement has been prepared. So real accounts, as I have explained, they are the assets owned by the assets owned like factories, furniture, building, computers. So they are they are all the examples of assets which are given here. So what is the rule for accounting of the real accounts? So when we are doing accounting for the real account, so the rule is, accounting rule is, debit what comes in and credit what goes out. So company XYZ purchases third machinery worth 100 rupees 1,000 for cash. So XYZ Private Limited here is what? Is a personal account. Okay. And machinery here is a asset. Asset is a real account. Okay. So machinery, so going by the rule, machinery will get debited by 1,000 rupees. Debit what comes in is the rule, to cash, because XYZ has paid through cash. So then that means to cash 1,000 rupees, what is going out, credited. Coming next, nominal accounts. It relates to the expenses and income. Basically, the P&L account, the profit and loss account, the income statement of an organization, those accounts where all expenses and the incomes are recorded, revenues are recorded, that becomes the that is the nature that are categorized as nominal accounts. So your salary payments, which are your expenses are always shown in minus. So expenses, salary, bank charges, electricity expense, internet, interest on loan, any other expense which you can think of, like your general admin expenses, like an IT cost, which an organization may be incurring, like any sales and marketing expenditure that an organization is incurring, that all here in this, they are all expenses. And the interest income that an organization is receiving, or income through sales, revenues, whatever income they are receiving, they are also the nominal account. So the rule for accounting of nominal account is that all expenses and losses, whatever expense and loss there are, a business incurs in a particular financial year, that becomes the, yeah, you have to debit that. The expenses and losses are debited, and incomes and gains are credited. Income and gains are credited, and expenses and losses are debited. So any sort of income and expense will have a direct impact on the capital. So what is capital? Do any one of you have an idea what is a capital? So okay, capital means money required by a business to run its operation, to acquire the assets. So what do you think? Who will put in this capital? Who will put in the capital? Right. Promoters, shareholders, right, owners.
Invest. Yeah, shareholders.
Yeah. So all these guys, all these investors who are promoters, shareholders, they will all put in the capital. They'll all put in the money. So if a business incurs expenses, so what will eventually reduce? The capital. Yeah. And if a business earns income, if it get gains, if it earns profits, what will enhance it? The capital will only enhance. Okay. So owner's interest. If a business is making losses, owner's interest will lose. Owner's share will get reduced. And if it is earning profit, the owner's shares will the owner's share owners will only benefit. So losses and incomes have direct impact on the capital of the business. So if we take an example here, so of the nominal account, Mr. X purchased goods worth 500 for cash. So if you are purchasing anything, that means you are incurring an expense. So purchases account debit to cash account, which is being paid to acquire the goods. So to quickly summarize this, for all personal accounts, the aspect of, the debit aspect would be the receiver, debit the receiver, credit the giver. In case of real accounts, you have to debit what comes in, credit what goes out. In case of nominal accounts, all expenses and losses will get debited, and all incomes and gains will get credited. I hope it's clear till here. Okay, so now let's before moving on next, let's have a question here. Mr. X withdraws 1,000 rupees from bank. So what would be so Snigdha, I'll just address your question here. So for the others, Snigdha, I'll come back to you. So for others, let's try and attempt this. What would be an accounting entry for a transaction which is Mr. X withdraws 1,000 rupees from bank? Let's try and attempt an accounting entry for this. So
bank account to cash account.
Bank account to cash account. Okay.
No, like actually.
Cash account debit to bank.
If there is a name of a person.
Cash account debit to bank account, that's right. Mr. X's account debit bank account. Okay, Mr. X has withdrawn cash. So basically what has gone up is cash has gone up. Okay, and what has reduced is bank has reduced. So basically we have to transact between cash and bank. So cash account is debited and bank is reduced. So Snigdha, if I may ask you, what's the confusion here with the debit and credit? I have given you the rules on the debit. The rules are here in front of you. So whenever there is a transaction, you have to identify that sort of an account there is, which type of accounts there is a transaction between. Okay, and then you have to debit accordingly. If it's a personal, if there is transaction between personal account, so then receiver will get debit, will get credited. If it's a real account that we are transacting So then whatever that is coming in, like example that I have just posted to you, cash and bank wala. So the cash and bank both accounts. So cash is coming in, so that means cash account debited, and bank through bank was going out, so bank account got credited.
Okay. Fine.
Okay. Yeah.
Yeah.
Okay. So next, ABC Limited, company ABC Limited paid 2 lakh salary to staff. What would be accounting entry? Let's try and attempt that. Salary of 2 lakhs paid to the employees of ABC Limited.
ABC Limited to salary
account, salary account debit to
or I'm
bank
opposite. No, not that.
Right. Salary account debit to bank account. What sort of an account is the salary account?
Oh,
it's
What sort of an account is the salary account?
I have a doubt.
Nominal account.
It's nominal.
Yes, please. Yes, it's nominal. And
Okay. Why not?
sorry, please continue.
Why not the in the name like Mr. X? Why back?
I didn't get you completely, Snigdha, here.
Yeah. I'm saying like why the bank account is there? Why not the name is there? Like you have said, Mr. X. The name was Mr. X, no?
So if I'm doing accounting
Like
for
entry should be.
So if I'm doing accounting for Mr. X, okay? If I'm
Okay.
doing accounting for Mr. X, so what is increasing in Mr. X's, assets and liabilities? What is increasing and decreasing? Mr. X's cash is going up and bank account is going down.
Okay. Okay. Now I got it. Yeah.
Yes. So in the present example, wherein the transaction says paying salary of 2 lakhs rupees to the staff by cash, so the transaction would be salary account debit to cash account, or salary account debit by 2 lakhs and cash account credit by 2 lakhs. Salary account is a nominal account here, and cash is the real account. So by the accounting rule mentioned here, debit all expenses. So that is why salary is being debited, cash being real account, and it is going out. So cash is being credited. Credit what goes out. So by looking at the examples that we have just gone through here, what we can analyze is that for every transaction there are two legs, debit and credit side, right? That means the accounting moves on double entry bookkeeping system. The system of bookkeeping has been so named because every transaction has a balancing impact on the other side. So every entry, accounting follows is a double entry bookkeeping system. So if we say Mr. X has earned 100 rupees, so if he has earned, what has happened is his income has gone up. Income has gone up. So income being what sort of an account? Nominal account. So income is good. So nominal account says credit all income and gains. So it is getting credited. And what is increasing by earning 100 rupees? His cash or bank balance would be increasing. So debit what comes in. It is the nature of real account. So what are the various features of double entry bookkeeping system? So the present day bookkeeping system, it allows to capture the transaction as on date, present date, as on today's date. It affects at least two accounts that we have understood, that there will always be a plus and minus impact on any of the two accounts in the any of the two accounts for the particular transaction. Okay, so debit, so that those two accounts, one will have a debit impact and another will have a credit impact. And always for a given transaction, the debit and credit side will remain equal. It cannot be that somebody has earned an income of 100 rupees. So you can't, there cannot be an entry like income getting credited by 100, but bank account getting debited by 50 rupees only. Can there be a possibility like this? No, there cannot be a possibility like this. So if your debit and credit will always remain equal in the double entry bookkeeping system. Okay, so and assets for a double entry bookkeeping system in a balance sheet, if we look at that, so assets will always remain equal to liabilities plus the equity, the capital that the shareholders have invested in. So let's take another example. Mr. P acquires a shop. Mr. P acquires a shop from the seller. So what will happen? There will be an accounting impact. There will be an accounting impact in both the buyer's buyer's book as well as the seller's book. Okay, so here the buyer is Mr. P, and let's say Mr. X is the seller of the shop. So transaction is buying and selling of the shop. So buying and selling of the shop, obviously the asset that is being traded off, which is shop, and the other thing which is involved is the cash portion, which is the money portion. Okay, so if we look at the buyer, who is Mr. P, if we look at his in his books, if we'll have a look at his books of accounts, his books of accounts will have an entry, shop or building, whatever he is buying, that is getting debited, because shop and building being asset in nature, real in nature, it will become debit what comes in. So debited, and what is going out? Cash. Cash is going out, it will get credited. So his Mr. P's books will reflect shop or building or assets account debit to cash with whatever monetary value that shop is being traded off. Whereas the seller, who is Mr. X, if I take an example, so his books will show the opposite entry. What sort of an entry it will show? In his books, cash is coming in, so he will debit the cash or bank by whatever amount of the monetary transaction to what is going out. The building or shop is moving out, so his entry would be bank or cash account debit to the building or the assets account. So this slide clearly represents that cash for the buyer, cash is going down and the asset is going up, and for the seller, asset is going down and the cash is going up. Moving next. So when we talk about accounts, so what sort of accounts? There are two types of accounts that are basically it's a cash basis accounting, not accrual basis accounting. Example, cash basis and accrual basis accounting. I will come next in this during this slide. I will touch upon this topic of basis of accounting, cash and accrual basis. Okay, I'll clarify to you when we reach that particular slide. So what type of accounts we are maintaining? What type of accounts are being maintained? Managerial accounts and the financial accounts. Type of the accounts, so as by going by the nomenclature, the accounts which are being prepared for the management, for the internal users, for the managers, probably they are called the managerial accounting. This form of accounts provide accounting information to help managers make decision for a business. Okay, so there will be budgets. So there will be an analysis on how the actuals have fared in comparison to the budgets. what are the controls that have worked and what are the controls that are required to be, they're still tightened or, better implemented. Financial accounting, on the other hand, it is the formal, form of presenting your accounts, which is readable by all. Not, it is the target audience is not only the internal audience, it is common for everyone. So the format remains common across business. Financial accounts have a particular format, so that it serves the common purpose for the internal as well as the external users of the account. So when we are moving in this tutorial session, we will be talking about the financial accounting. We are touching only on the financial accounting. Financial accounting. It is used, so as I have explained you, it is a tool which is used by the managers and the external and internal users both. They are used for the, this financial accounts are used by both internal and external users. So it is a statement of the revenues, expenses, assets, liabilities of the business. So financial accounts deals with the financial transaction, making summaries, communicating the results, recording of the information, interpreting the information, classification, analyzing of the data. These all steps are performed while we prepare the financial accounting. So all sort of these steps, when these all steps are actually followed, then only the conclusion becomes the financial accounts of a financial statements of a particular business. So, but when we look at the financial accounts, there are certain limitations also. There are certain, there are certain limitations of the financial accounts. So first, we only talk, this is only quantitative information. That means it only talks about the transactions which have the monetary impact, which can be measured. There are hundreds of, there are many instances where non-monetary circumstances have an impact, has an equal or a larger impact on the business. Like, what best, I can give you an example of the present situation than anything else. So COVID, non-monetary impact, but a huge impact on all sort of businesses. So no business's financial statements would have been able to predict the impact of such sort of a pandemic on their businesses. Many businesses have, just gone to the level, those who may be posting the profits of crores and crores in their financial statements, they are on the brink of, closures, and they've suffered huge in this during this period. So, but unfortunately, financial statements could not have predicted this, could not have shown this. In fact, in today's scenario also, there cannot be any measurement of what is the impact of this sort of a pandemic on the business. This can't be shown in a financial statement. Another limitation is that it is done on a historical cost. Historical cost means the cost at which the which has been incurred to acquire an asset, basically. So if I buy something, if I buy a piece of land, I may buy it at 1 lakh rupees, but today it would have increased. When I had started the business, my office building would have costed me 1 lakh rupees. Now, after 5 or 7 years, obviously the value of that 1 lakh rupees would have gone up. But now, what my financial statements will not present it at the at this, they will not take into the consideration that increased cost. They'll only take the historical cost. My building and land will continue to appear at the price of 1 lakh rupees, and maybe less than that due to the depreciation impact of that. Okay. So next is, it is a very macro level information. It provides, there are deeper, there are financial, by looking at the financial statement, nobody can understand, nobody can make an idea of what, deepest level of issues are there in an organization, to manage in an organization. So price level changes, that means it's not always comparable. So one if I'm looking at the financial statements of two organizations into the same sector, I am not able to always, equally compare one to the others, because owing to the different business, business compositions, or probably business ethics or whatever, their financial statements will not, they are not, there cannot be an apples to apples comparison between the two financial statements. So it doesn't, the financial statement does not provide your budget and actual picture. They do not show you the actual picture, because actual picture may vary, so businesses may be posting the profits, but actually the market scenario, the economic condition of the economic condition of a country, various other impacts, there may be impacts of those conditions on the business, which a financial statement may not be very, easily be able to predict. So there's always a scope of manipulation in this preparing financial statements, though with the use of accounting standards, with the guidelines which are used to prepare these financial statements, the guidelines are there only to reduce this scope of manipulation, but still it's not completely out of, it's not completely out of the picture. That manipulation scope always remains. The last one is that it's very, very technical in nature. Nobody can, it's not that any other person's job to prepare the financial statements and do financial accounting. It gets really technical, how to present and analyze the transaction and see the implications. So accounting and bookkeeping, there is difference between the two concepts of accounting and bookkeeping. Bookkeeping generally only involves of recording the financial transaction. That means doing debit and credit. That is bookkeeping. It is just one part of accounting. Whereas, from recording to summarizing to analyzing to presenting, this all becomes part of the financial, this all becomes part of the accounting. So accounting is a broader concept. Accounting is a very, very broader concept, whereas bookkeeping is mainly concerned with recording of the transaction. So recording and reporting of any sort of a transaction is considered as the financial events. So accounting and financial reporting, accounting means bookkeeping, maintaining the accounts, and reporting means presenting them into the into the fixed formats as per the requirement of the statute or requirement by the posted by the Companies Act. Accounting as a profession. Accounting as a profession, there are three major type of accounting professions. One is public accountants. Their expertise is for the general public, and there is services. There are services for their services are for the general public. Private accountants, they are the employees by the individual organization and everybody who are related to the particular business. So they're accounting, doing accounting for their transactions. They are for the private accountants, and not for profit accounting. This is for NGOs, government institutions, etc. So they do accounting for the accounting for the government institutes and the foundations and this hospitals, etc. They are being done by not-for-profit accounting people. So another very important topic that we're going to touch upon here is ethics. So while when we're dealing with the subject of accounts, so accounts is a very, very since it deals with the money matters, so it's a very delicate, it's a very, very very delicate kind of a topic to deal with, and therefore it is very, very, very important to have the ethics, proper ethics, and various high standards or SOPs to and conduct to while dealing with the accounts and the accounting of the transactions. So what are ethics? Ethics are standard of conduct. While you are dealing with transactions, you must have, because it is your interpretation, it is in accountant's hand to interpret and present the transaction. So it is very, very important that the conduct and the standard of conduct and the high standard of ethics are being followed, and high level of integrity is being followed while dealing with the financial transactions. So there is then there comes a situation which is called ethical dilemma. So for any sort of an accountant who's working for a business, many of them come across a situation which is called an ethical dilemma, where they get in a dilemma for dealing with the interest of the organization, with the interest of the management for which they are working, and the next, what should be this ideal scenario. So like a management, in interest of showing brighter balance sheet, brighter financial position of its business, may ask, if I may give you an example, there's a contract which an organization has entered, wherein the revenue will come in in the period of 5 years. Revenue will come in the period of 5 years. Let's say there's a contract. So management may want that they have entered into a contract, and they may want that the entire revenue for the 5 years, which is going to accrue in the 5 years, accounting accounts may present the revenue or record and show the revenue in the first year itself, in a particular year itself, but which is not the ideal way. The ideal way is that whatever is pertaining to the current year's share should only be recorded. So this, while principle of accounting remains on the one side, the interest of the management becomes that is also very, very important, for which a particular person is working. So that dealing with that particular sort of a situation, it is that particular ethical dilemma situation, it is very important that a person has a very, very clear head on how to deal with it. So he has to understand that there are severe ramifications of presenting the accounts in not that correct frame, and he has to understand that management is not the only interested party. It is not only the interested party. There are other people who are also the equal stakeholder interested parties in the business. So the financial statements have to be presented in their true and fair form. So and in any ways, defrauding will only give a business the downward slope. So a very, very famous example in this context of defrauding, of being management getting very, very aggressive on showing the bright picture for their on their business front, on their financial front, was the very famous case of Satyam. I hope everybody remembers Satyam's case. Ramalinga Raju, the founder, the promoter of this business, right? So what did he do? In order to show very, very promising organization, a very profit-making organization, a very bright organization, what did he do? He made fake receipts, he showed fake sales, he prepared fake bills, and he showed higher revenues. He started inflating his balance sheet and revenues. So when this got exposed, what was the ramification? Satyam's employees, they were, Satyam was taken over. There were ramifications for its auditors. There were ramifications for the employees. The promoter was behind the bars. So there are, ramification and the downward slope. Satyam was acquired and eventually taken over. The name of Satyam has gone. I remember when at those times Satyam was such a highly, referred to as an organization, but now the entirely the spot is gone. The organization is off. So the existence is altogether gone. So this is what is the ramification of being getting very bullish on this your financial positions. So what should one do when while he is presented with a position of ethical dilemma? He should recognize the situation and the issues involved. One should analyze the elements, what sort of an impact it will have, and how he can counter it. How can if there is any way if this can be balanced, so that balance has to be brought in. Otherwise, it is always recommended that we as an accountants present the fair picture, the true picture, and the ideal picture that should have been to a particular transaction. I hope it is all clear till this point in time. What do you suggest? Shall we get into a break for 10 minutes? Let's get for the 10 minutes break, and then we can continue. Or is it fine for you to continue? Okay, so now let's continue till 1:30, and then we shall have a 5-10 minutes break. Next topic, financial terminologies. So financial terms that you may be hearing in your environment, whereas there are specific, as I've told you, that accounting is a specific business language. So there are specific terminologies for the accounts related for the accounting. So one is, the first one to make is sales and revenue. As we all understand, what is sales? Sales is something, the money, the value of the product which is derived after selling them in the market. So company, whatever company earns by selling that the product in the market is called the revenue. So sales will give rise to revenues. Overheads, so expenditure which is incurred over and above the cost of the product. So if I am a manufacturing business, so I may be incurring a cost of 100 rupees to make the product, but over and above I may have a cost of running the office, I may have a cost of taking it to market, I may have a cost of storing it. They all become my overheads. So whatever cost whatever cost a business is incurring to over and above the cost of its production is called the overheads. So profits, obviously the revenues minus your costs become your profits. So whatever extra you earn by selling the product in the market will become your profit. So value of a business. The value of a business is basically, business takes risks. So business takes risk, and so it represents, basically value is also the profit. It says that you're taking a risk, so you are generating through whatever sales you are generating. This is the amount, this is the award for taking the risk. So that becomes the value of a business. Assets are those assets are, I'm sorry, anything which can give which has the future liquidity value, which will give cash benefits in future, which can be converted into the cash in the near future, or whenever the time arises. That is termed as assets. So the fair example of assets is your plant, machinery, building, your trade receivables, your debtors, So they are cash and cash equivalents basically. So that are your assets. Liabilities, whatever is, whatever it requires to pay off the business, for a business to pay to the third parties, that becomes your liability. So your debts, your anything, your purchases on the credit that you owe in the market, that becomes your liability. So debt is a liability. Debt means the loans that you have taken. Equity means the shareholders' money, the amount that the shareholders have invested, that becomes your equity. So how do you arrive at equity? From the total assets, if you minus the liabilities, that becomes your equity. Capital expenditure, the expenditure that an organization earns to acquire the fixed assets, becomes your is termed as your capital expenditure. I hope everyone is clear on fixed assets. What are fixed assets? What are fixed assets? Right, assets which help in income generation of a company, assets which have, life of more than a year. Okay, which have and life of more than, which have life of more than a year, and which can be converted, into the cash after more than a year also. So they are all fixed assets. Capital expenditure, anything to acquire those sort of an assets become your capital expenditure. So this brings us to our next topic of accounting conventions. So accounting, there are two bases of accounting: cash basis and accrual basis of accounting. So cash basis of accounting means, you actually record for a transaction. In cash basis of accounting, you actually record the transaction as and when there is an exchange of a cash of a particular transaction. So that means if I say I have made sales on credit. Okay, so I have made it on credit. I have not, I have not got cash in exchange, so I'll not account for that transaction. So this is, where if you are doing cash basis accounting, that means when you will get cash, only then you will account for that sale. Whereas in accrual concept, what happens is, if you have made the sales in today's time, whether it be cash or it is on credit, you will account for that sale on the accrual basis. So likewise, on the other front, if you have paid, if you've paid for an expenditure, let's say which is for the period of more than 1 year, let's say, if you have paid for what sort of example I should take? If you have paid for a license fees for acquiring some sort of an asset. For some sort of an asset, so that license, they may be active for more than a year. The license fees may be for 2 or 3 years, but you've paid today. So what will happen in the accrual concept? You will only account for as an expense the amount which is pertaining to the current year. If total 100 rupees you have paid, and that 100 rupees is for, let's say, 2 years. So in the current year's profit and loss account, only 50 rupees will be accounted as an expense for this year, because 50 is for the next year. So in next year's financial statement, the expense of 50 rupees will come there, although you have paid cash today. So basis the explanation, which of the following illustrate accrual concept? A company is in the second year of trading. It applied straight line depreciation to its fleet of motor vehicles in the first year and is applying the same in the second year. So what sort of which out of the three represents the accrual concept? Assets are carried in the books at what the entity has paid for them, less depreciation wherever it is appropriate. Prepaid rent at the end of the accounting period is treated as an asset and carried over to the following period. Which out of the three?
Third one.
Right, third one is the right answer. Could you please explain treatment of accrual revenue in books? Accrual revenue, I think you mean to say accrued revenue. So like my first example, if you have paid, accrued revenue is the revenue which is due to you, which you have earned, but you have not, collected it in cash. That is accrued revenue. So my first example was that example. So now if I may clarify, if you have a fixed deposit, and there is an interest on it, okay, so you will account for that interest, although you will get the interest on a yearly basis or 6 monthly basis, but you will, when you are maintaining the periodical accounts, you will show that interest as an income which is accrued to you. So that revenue is there for you. That it means whenever, if you will go and liquidate your FD now, you will earn that revenue, you will earn that amount of interest. So that interest has accrued to you, but it has not come as in cash to you. I hope I'm clear with this, Sushant. How to do the entry in the books? So entry is like any other any other entry. You will credit your income. You will credit your income and you will debit the accrued revenue. That means you will debit your it will stand as an asset receivable in your books of accounts. So interest accrued debit to interest income is the entry. I hope I'm clear, Sushant. Shall we move on next? Yes. Since cash and bank account has not hit right now, you've not received cash in bank, you will debit the accrued revenue as an account there. So moving next, let's touch upon what are the major accounting concepts, the concepts on which the accounts are prepared. So the major accounting concepts are going concern. Business will continue as a going concern. We do not, anybody doesn't do, do not runs a business with an aim of running it only for a limited period. Nobody says that I am opening a shop and I will close it in the 2 years period of time. Okay, so business is always looked upon as a going concern. It has a foreseeable future. It is not that the continuity is unforeseen. Whenever you may not understand that whenever intermittently it may get disrupted and the business operations is wind up. You don't see business like that. Accrual concept, like we have spoken, a major accounting concepts. Accounting is based on accrual concepts only. Cash based accounting is not. We are not permitted to do the cash basis accounting. So income and expenditure must be recognized in the accounting period for which they relate to. If an income pertains to current year, no matter if it has come as in cash to you or if it hasn't, you have to account for that income. Likewise, any expense which pertains to the current financial year, no matter you've paid it or you've not paid it, you have to show it as an expense for the current year only. only transaction which can be quantified, which can be measured in the money terms, are recorded in are recording for the accounting purposes. So other major concepts are economic entity. That means every society, in a society, every organization, every other organization is treated as a different economic activity, and business is treated as different from its owners and investors. So business has a different individual economic identity. Periodic concepts. The financial results are presented. Financial results are presented in a periodic manner. It could be every year, every 6 months, every quarter. So there is a periodicity. It cannot be that on any other day you present your financial results. Cost concept. The cost is only considered in the cost at which you have acquired your asset, or at which the cost that you have incurred for a particular expense is only used to in your accounting statements. It's not the realizable value. That means, again, if I quote that example, if you've purchased a building for say 1 lakh, and now its realizable value is, like, if you go and sell it in the market, if you may fetch 5 lakhs for it, so your accounts will not show your building at 5 lakhs. They'll continue to show it at the original acquired cost, the cost. So this is the cost concept. So and the last one is the dual accounting. So that means, like we have discussed, that every transaction has has two sides, debit and the credit side. So there are dual effect on the accounts for any particular transaction. Realizable value means the value that you are going to get if you sell that thing in the market. What is the market value? Realizable value you can say as a market value. So if I may say, if you're manufacturing a product, okay, so if you're manufacturing, let's say a car, to manufacture a car, it says it takes you 3 lakh rupees. Okay, but you may tomorrow go and sell that same car in the market at the price of 8 or 10 lakh rupees. Okay, so your books will not show your cars at the your inventory at the rate of 10 lakhs. It will continue to show the inventory at the rate of 3 lakhs only. Okay, though the realizable value, that means you go and sell that inventory in the market, it will fetch you 10 lakhs. Okay, so the market value of that is 10 lakhs, but as long as it is in your books, it doesn't get converted into the cash. It will continue to appear at a rate of 3 lakhs, right? So there are certain terminologies related to the accrual concept when we're talking historical cost, the value at which the asset was purchased, or the original value of a liability. So like we have discussed, the original cost of acquisition of an asset or the payment value of a liability represents is the meaning of the historical cost. The example is the amount of debt raised. So economic activity, like we have discussed, the organizations are different from its owners. So whenever we say that we are presenting an account for the business, so Reliance is presenting its account, it does not mean that they are the accounts of Mr. Mukesh Ambani. So accounts so business is a different economic activity. It has a different identity than the owners and the investors, and its investors. The periodicity, it says that assumption that a company's ongoing activities can be divided up. It can be reported annually, quarterly, monthly in the financial statement. Money measurement, that means any transaction which can be measured in money terms can only be shown in the accounting as an accounting information in the financial statements. Materiality. Materiality means that there is always a threshold. I can't, for a business, materiality defines the threshold or the cutoff point after which the financial information relevant to the decision making needs of the user. So materiality means, there are transactions which appear in the balance sheet, but only those transactions which are material to decision making in a business. Okay, only they become relevant, only they are considered material, and they are given more weightage in the account in the financial statements. Moving next, that the financial statements must be objective. They must be objective in nature. That means they must not present anybody's single opinion. It must not be from somebody's point of view. It has to be, I should say, independent, universal in nature, unbiased in nature. It should not be like that. Okay, so and the last of all is that whatever information that we are that is presented in financial statement, that must be understandable. It should not be that complicated that it takes an effort for everybody else to understand, to interpret that information. It should be facilitated, it should be user friendly in that parlance. So qualities of accounting information, that it should be reliable. Obviously, it has to be reliable. Only then, there can be a trust that a business is presenting a fair picture. It should be relevant. That means it should be presented in a way that it gives relevance to the business and its decision making activity. And then it should be comparable. That it should have a consistency period to whether it is comparing it with the market in the same industry, across the industry, or whether it is compared with its own financials in the previous years. It should not be like if it is presented in a format A in 1 year, format B in next year, format C in the another year. So if it is, it cannot be like that. So they must be comparable, reliable, and relevant. So before we move on to the next, let's have a 10 minutes break and let's catch sharp at 1:40. Yeah. Any questions, anyone? Okay. So, hello everyone, and welcome back. Shall we move to the next topic then? Basic accounting equation. So the accounting equation, the basic accounting equation that we spoke was assets is equal to liabilities plus owner's equity. We said that in a balance sheet, the assets and liabilities side will remain equal, and assets are always equal to liabilities and owner's equity. That means owner equity is also shown as liability in a balance sheet. So net working capital, that means capital in a business, is also, that is why calculated as total current assets minus current liabilities. The assets are of two types, fixed assets and the current assets. Fixed assets are those assets which I have already explained have the lifetime, expected lifetime of more than a year. And current assets, that means that will be converted into cash in less than a year's time. That are all current liability assets. Likewise, current liabilities will mean the liabilities which have to be paid off in the period which is less than 1 year, and current the long-term liabilities would be the liabilities which have the payment payment date of more than a, which will get paid off in more than a year's time. So they are all long-term liabilities. So let's attempt a question. Let's try and find out the shareholders' equity in the question that I am now putting it across to you. A company has following assets and liabilities. The company has fixed assets of 70, current assets of 50, current liabilities of 30, and long-term liabilities of 10. Should I write it for you in the chat box? Should I display that? Okay, so let me do one thing. I'll display it on the Excel sheet here for you. Fixed assets are 70. Current assets are 50. Current liabilities are 30. And long-term liabilities are 10. Can we please have the amount of, can you please all
80.
calculate me the equity?
80.
80 is the answer, correct. I hope everybody has arrived at 80 as an answer. So the solution was the total assets, that means fixed and current assets, and we have to calculate total liabilities, which is 30 plus 10. And if we reduce liabilities from assets, we arrive at 80, which is the owner's equity. In the similar question, if I may say that what is the working capital? Can you please calculate working capital in the same question?
20.
That's right.
Correct.
20 is the
Yeah.
answer.
20, yeah.
20 is the answer. That means current assets minus current liabilities, which is 50 minus 30. It is 20. So I hope everyone is clear on this. this we've already covered. The accounting transaction, that when the cash is withdrawn and when the salary is paid. We have already discussed the rules of accounting. So accounting standards in India. What are the accounting rules, accounting standards that are being followed in India? So in India, the MCA, so the general accounting rules, the general accounting, generally accepted accounting principles, they are, being notified by the Ministry of Corporate Affairs. So they are, GAP is being followed. That is abbreviated as GAP. So GAP follows conservative accounting, conservative principle of accounting, where it says that anticipate no profits but provide for all possible losses or expenses. So GAP is basically the rules by the MCA, which they have notified in the Companies Act. They are these accounting standards. Now they are accounting standards of 2006, according to which the accounts of an organization have to be presented. So in India, accounts are prepared according to the three principles, according to the three rules, three standards. I'm sorry, which is GAP, INDS, which is Indian Accounting Standards, and IFRS, International which is International Standards of Accounting. So GAP is basically the standard framework for all the organizations to follow the financial accounting. So on February 2015, MCA has notified the new rules. Now INDS has taken over the GAP. So earlier, according to IGAP, Indian GAP, the accounts were maintained, but now accounts have been maintained, have been changed. The presentation of accounts have been changed through INDS rules. The MCA has notified new rules of accounting in 2015, February 2015. They are called Indian Accounting Standards. They are in comparison to the IFRS standards, which are internationally followed rules of accounting. So these rules, they specify the accounting, standards, the set, the accounting methodologies to the particular set of companies. So all those companies which were listed in India or outside India, listed means whose assets or whose equity, whose shares are listed or their debt are listed in the stock exchange. And if the business net worth is more than 500 crores or equal to 500 crores, they had to shift to INDS from and before April 2016. And for all those unlisted companies which have not been listed, and if their net worth is more than 500 crores, even they had to start adopting they had to move to INDS accounting from April 2016. While all other companies which were listed but had the net worth of less than 500 crores, they were to adopt the INDS accounting method from April 2017. And likewise, unlisted companies whose net worth was from 250 crores to 500 crores were to adopt from April 2017. While for the companies whose net worth is less than 250 crores, they can continue maintaining their accounts on the IGAP accounting standard that is followed prior to INDS. So any company which is a sister concern, holding, subsidiary, or a JV company, or an associate company of a listed entity, or the unlisted entity, which if they are listed or unlisted entity, but they are holding in a related entity to the entity which is falling in the above mentioned worth, and they were to adopt the accounting practices, they were to also move to the accounting practices. So if an organization whose net worth is more than 500 crores and is an unlisted organization and has 5 or 10 of its subsidiaries whose net worth may be only few crores only, like 4 or 5 crores only. So if the parent has to move to the IND AS accounting, these subsidiaries and the associate companies also have to move to the the IND AS accounting, no matter if their individual net worth is not meeting the criteria. So, what is the difference between IND AS and the IFRS statements? So, the only the difference between the GAAP and the IFRS statements is that they are presented in the different ways. They are presented in the different formats, and the calculation of certain certain concepts have changed in the IFRS than it was being followed in the GAAP. So GAAP requires 3 years of data comparative data, while IFRS now only requires 2 years of comparative data in the financial statements. So when we're talking about the balance sheet that is presented in GAAP and the IFRS. So GAAP requires assets and liabilities to be presented in the decreasing order of their liquidity, while IFRS doesn't mandate any such format. It says you can present it in the it says that you have to present it in the form of what is the current assets and the non-current assets and liabilities. Balance sheet is generally presented with the total assets equaling total liabilities and shareholders' equity in the GAAP. When we are presenting the financial statements in the GAAP format.
Hi, Nega.
Yeah.
So I have a little confusion here. So can you please clarify that? So why GAAP and IFRS presents?
Why GAAP and IFRS?
So presents. So what is the importance? And I know it is a regulator, right?
No. So GAAP and IFRS, they are for for a very generic understanding. I may say they GAAP and IFRS, they are both the rules of accounting. They are both the formats of presenting your accounts. Okay. So GAAP is way one of presenting, IFRS is way two. So GAAP is has now in India also, GAAP is now not relevant to the organizations whose net worth is more than 250 crores. Small businesses may continue, following the GAAP principles for accounting, but now for any big businesses which is more than 250 crores of their net worth, they have to come to the IND AS accounting. There are new rules of accounting which are in matching with IFRS, which is the international rules for the accounting. This standardization has all been made so that there was an actual challenge when comparing the results of businesses across the economies and across the globe. So one cannot compare like we've been dealing with this in our previous slides, that comparison of the two financial statements becomes really different if you're following different sets of accounting. So this has been done, the standardization has been brought into the picture so as to the entire global economies and the businesses can, present some homogeneous sort of, we can make some common sense out of the financial statements from the organizations across.
Okay.
Moving on next. Books of entries. So what are the various books of entries that are, maintained to record the transactions? So one is journal, another is ledger, and the third one is the cash in bank. So journal basically records your transaction first in, first out. You keep on incurring you keep on recording the transaction one after the other in the journal form in the book called journal. So book of original entry of all transaction. This is the first book of entry, records the transaction as and when they occur. So journal is like the running book. You keep on recording the transaction one after the another in the journal. So after you have recorded all the entries in the journal, it is the time to classify the similar nature entries into their individual ledgers. Final resting place for all transactions. So if there is an expense so of a particular nature, so all the expenses will get classified into that particular expense ledger. After they'll be summarized from the journal, and they'll be now then individually recorded into their individual ledgers. So ledgers is the final place of all the transaction. From the ledgers, their trial balance is then maintained. Sorry, excuse me. So trial balance is maintained from the individual account ledgers. Cash in bank, as the name suggests, it is the cash in bank book entry. So like your passbooks and checkbooks, this is the cash dealing accounts. So in the books of entry, the transaction when it is a transaction when happens, then it is entered in the journal. Then the books of primary journal and subsidiary books are maintained. Then posting happens in the secondary ledger, which is the ledger that we've just spoke. From ledger, a trial balance is maintained, and then from trial balance, a final profit and loss and balance sheets are maintained. So a general ledger is basically, what is a general ledger? A general ledger is the collection of all the accounts, all the entries that are posted in various accounts, and then they are shown as that becomes the general ledger. The general ledger can be supported by one or more subsidiary ledger that provides the detail of the accounts for the general ledger. So it can be supported by the subsidiary ledgers. That means a general ledger will have the posting of all the entries that have gone in the individual ledgers, in the individual expense ledgers, or you may say revenue income ledgers. So general ledger will have entries and posting of entire set of entries in the that have been accounted for in the individual ledgers. So general ledger is basically very, very important, because the entire income statement and the entire basically financial statement is derived from the general ledger only. It contains of, each account in the general ledger will have details of all the entries that are in their account. It is the general ledger is the ledger where the posting of accounts actually happens. Where the final accounting entries rests. That is the general ledger. Posting is the process of recording amounts as credits and debits in the different pages of general ledger. So general ledger basically has, the left side is the debit side and the right side is the credit side of a general ledger is a book in that format. So it has the transactions, all the transactions where the debits and credits appear. Additional columns to the right hold a running activity or the total. So there's a column on the right hand side where after every transaction the total will appear, like you may have seen in your bank account statements also. So what should general ledger include? It should include date, description, balance, and total amount for each account. General ledger is usually divided into at least 5 main categories. So general ledger has basically 5 different divisions. Liability is assets, expenses, revenue, and the owner's equity. So like owner's equity, assets, and liabilities, they form balance sheet. Expenses and revenue, they form the income and expenditure statement. What is a trial balance now? Trial balance is the summarized statement prepared by extracting the debit
Hello?
and the credit balances.
Hello,
Yes.
Neha.
Yeah,
Can you
yeah.
please show me the last slide?
Yes.
Yeah, just a second, okay? Yeah. Done.
Done. Thank you.
Yeah.
Yeah. So what is a trial balance? So trial balance is basically the summary of all the ledgers, debit or the credit, whatever. So all the heads of the accounts, when they are summarized to form the trial balance. Debit should always be equal to the credit. That means in a trial balance, your debit and credit side will always be would always be equal. That a trial balance is a running record. That means a total of a trial balance, all plus and minus, will become eventually zero. It does not check the authenticity of a transaction, since it is only the summary. It is only the summary of the entire account balances. It does not have the details of the transaction, and hence you cannot check the authenticity of the transaction. Trial balance is only true on a particular date. The balances will keep on moving, it will keep on changing with every transaction. So a trial balance is a statement which is true only at a particular date, and I would say on a continuing business, it is only true on a particular time only. True to a particular time. A trial balance keeps on changing with every other transaction. The moment the balances on any of the heads of the changes, the balances of the trial balance, the figures on the trial balance keep moving. So let's get on for some examples. Let's move on to some examples and exercise. Okay, so let me post to you some situations, and you will give me the solutions of the journal entries. So initial investment by owners of 1 lakh cash in a business. So what would be the journal entry? What do you think will be the journal entry? If I am an owner and I have invested 1 lakh rupees into the business, what will be the journal entry for this?
Capital account debit to cash.
No, sir, that is wrong. Misha, this is wrong.
Owner's account to capital account.
Owner's account? No. What has
Like
gone
who
up?
is the
Cash has gone up for a business. If I have to,
okay.
I have to separate the owner from the business. So what has gone up in the business? Cash has gone up. So cash debit to capital or equity, owner's equity, your owner account. So this will get credited. So the journal entry would be cash or bank account debit to the capital account. Okay. So out of that, now, if there is an acquisition of some machinery for 75,000, what will be the entry?
Machinery account to cash account.
Right. And on the other hand, if I buy some inventory for 20,000, what will be the entry?
Purchase account.
True that. I hope this is clear to everyone. I hope everybody is arriving at the same answer that we are discussing right now. Okay, so if I, in the same business, if there is an acquisition of inventory on credit, what will be the entry?
It's inventory account debit to party.
True, correct. Party means creditor, accounts
Creditor.
payable. Okay. So if there is a collection of debtor in a business for 30,000 rupees, what will be the entry?
Can you please repeat the question?
Repeat the question, ma'am.
The question is, if you collect the cash from,
Debt.
sales that you have made on credit, debtors,
Okay. Son. I guess son
receiving
debtor
payment
account
of
to
debt.
cash account.
Cash account debit to party. If we
True,
receive
cash
cash.
account debit. Exactly. If we receive cash, then
Cash
it is
account.
cash account debit to party. Okay. I hope everyone is clear till this point and we can safely move to the next topic, which is financial statements.
Yes, yes.
Okay. So what are financial statements? The statements that presents the financial condition of a business. That are called financial statements. And what are the examples of the financial statements? The profit and loss account.
Like which shows the performance of the business.
So examples of the financial statements?
P&L and balance sheet.
Like balance sheet.
P&L
Yes,
and
P&L. Very right. P&L, balance sheet, cash flow statement. They all become the
income statement and other.
exactly income statement is P&L statement. So income statement, balance sheet, cash flows, equity statement. They are all the four types of financial statement. So what does income statements tell? Income statement tell the revenues, the expenses, the earnings, the profits, the losses. They tell earning per share. Earning per share means how much is the profit per share, per a share invested in the company. That means you divide the total profit after tax by the total number of shares that have been issued. So you arrive at the figure called earning per share. Okay. So balance sheet, obviously balance sheet has the assets, liabilities, and then net worth of an organization. Equity statement of equity will only tell you that how the shareholders interest in a business has changed over a period of time. Okay, what have been the additions, or where have the business incurred losses, and hence there are reductions in the shareholders fund in the from the business. Cash flow statement obviously it tells about the cash position. Since we are preparing the accounts on the accrual basis, so cash position can be very, very different from the accounting position that are reflected by the balance sheet and the income statement. So therefore cash flow statements are maintained, because a business may be looking very promising from the balance sheet and the P&L front, but picture may be entirely different from the cash front. This we will discuss when moving forward. So that is why a cash flow is a very, very important financial statement. Uses of financial statements, as we all know that financial statements have been used by various people by internal and the external all interested parties to make various sort of a decision. So this is where the financial statements are used. The managers, they use the financial statements to evaluate the performance of the business. The investors, they want to know, how and where the business stands today. And the creditors, they want to get the comfort that, they'll be able to recover their money from the business operations in the due course. So employees, we have already spoken about. Employees are interested that how and our salaries and bonuses will get affected with the business operations. Government will derive that how my taxes and how accurately the taxes and the statutory compliances have been met according to the performance of the business as has been depicted in the financial position. Auditors will give a report and will give an independent opinion on how this business position and this this company is positioned in the market. The auditor's statement on the financials presents their view, independent view on the way this business is being conducted. Moving on next, let's discuss the accrual and the cash basis of accounting. So like we had discussed earlier, cash basis recognizes revenue when the cash is received and expenses when they are paid. It does not recognize account receivable or account payable. If we are only accounting for the entries when cash is realized, that means there is absolutely no question of accounts receivable and payables appearing in the financials if we are doing accounting on the cash basis. It is very, very simple to maintain, and it is generally used by very small businesses to do their accounting. Basically, you can easily say the small run shops and businesses, they use this cash basis of accounting. Okay, so transactions are easy to determine if they have happened or not. There is simple. There is no, there is no confusion about if an event has happened or not. If cash has come to you, the transaction has happened. If cash has not come to you, transaction has yet not happened. It is easily trackable because cash is a transaction that which can be tracked, which can be seen through the bank accounts, and it can be easily reconciled. Banks, so sir, they use real-time accounting. Banks do not follow cash basis. They deal with cash, that's a separate concept, but they also they have to pay interest. They have to receive interest. How can they do cash basis of accounting? Though there are defaulters who do not pay interest, bank has to continue show that interest is receivable from them. So banks do accrual basis of accounting. They do not do cash basis of accounting. Accrual basis. Accrual basis, on the other hand, revenue and expenses are recorded when they are earned, immaterial of the fact if they have been realized. So if you have earned a revenue, that means if you have completed your obligation, if you have completed your obligation of giving the services of selling a product, immaterial of the fact that you've received the cash against that or not, that sale is being accounted, that revenue is being accounted. More commonly used than cash system, obviously by big businesses, it is the accrual basis of accounting only that is being used. Give more realistic idea of income and expenses. Obviously, you will have a clear-cut idea that what actually has been the transaction for the particular period. It gives you a more realistic idea. You may not realize the cash in this particular period, but obviously the profit and the loss, or the loss pertains to this income and the expense pertain to the particular period when the accounts are being presented. Provides long-term picture of the business. Exactly. So accrual basis only will be able to provide you a long-term picture. You'll be able to gauge that if this is the real scenario of actual sales and expenses being incurred at this rate, how long can my business sustain? Doesn't provide any awareness of the cash flow. So one of the very, very downside of this is accrual basis is that it does not give you the picture of the cash statements. You may be, again, I am mentioning, you may be showing very good sales, very good revenue, but if they are all on the credit, that means your cash position is really tight. You have earned accounting profit, you have not earned cash profit, right? So it does not provide any awareness on the cash flow. Can be deceiving. Business can appear profitable even with an empty bank account. Do you all agree with what has been written here? A bank account may be an empty, but a profit now business may still appear very, very profitable on the balance sheet. Is this clear to you all? Moving on next. So after transactions are identified, recorded and summarized, 4 financial statements are prepared from the summarized accounting data. So what are the main 4 accounting statements that are prepared? One is income statement, another is balance sheet, cash flow, and the statement of owner's equity. Income statement we have discussed is the profit and loss statement. Balance sheet we've discussed is the statement of the assets and the liabilities. It also shows the picture on the owner's equity as on date. Cash flow presents the cash position of the cash inflows and outflows that a business has received. And the owner's equity provides the movement in the stake of the owners in the business. Apart from that, there are notes to the accounts which are integral part of the financial statement. Notes means they are those information which cannot be quantified, but will have a impact on the business's performance. So they come as a notes to the account. Balance sheet. So balance sheet is the statement of assets and liabilities at any given point in time. The assets will be equal to the liabilities. Okay, so what are assets? Assets are resources owned by the business which will help in generating economic benefits for the firm or which can be converted into cash in the short term. That means less than a year. Which of the following is an asset for a company? Now, since we all know what are assets, can you please identify what are the assets out of the 3 mentioned here on the screen? Bank overdrafts, receivables, or sales?
Receivables.
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 B1.
B.
Yeah.
Anybody having any question or confusion on the assets here? Why is bank overdraft not an asset? Bank overdraft will give you money, no?
But we have to pay once again to them, correct?
Right. So
It's a
overdrafts are,
liability. It's a
yes,
liability. and
overdrafts
to
is
pay.
a liability. And what about sales? Where will sales appear?
Sales is a revenue, not a
It's revenue.
assets.
Yeah.
It's a revenue.
Yeah, it's a
Not-
revenue.
Yeah, sales will be in the income statement. They will appear in income statement. They are not part of the balance sheet. They are not assets. All right. So I understand that the concept of assets and liabilities in a balance sheet is clear to you. So fixed assets are those which are acquired for long-term use in the business itself and are not for resale. Example is plant and machinery, lands and building. Current or floating assets are those which are meant to be converted into cash as soon as possible. That means debtors, like your receivables, you expect them to convert into the cash as soon as possible, right? Liquid assets are those assets which are present in the liquid form. That means they are cash or cash equivalents. All those current assets which are already in the form of cash or which are readily converted into the cash. Example, your investments in your mutual funds, they are all your liquid assets. Your FDs, okay, your securities, they are all your liquid assets. Wasting assets. This is an interesting asset. So wasting asset means the assets whose value will go down as as soon as the content of as soon as the exactly the content is utilized. So very appropriately an example of a coal mine has been mentioned here. So a coal mine is nothing but a, if I talk in a layman language, it's a deep down pit. Okay. So the why it is an asset to an organization, because it has a lot of coal which has a resellable value. If you will take out all the coal from a coal mine, if you have if you have mined the entire coal, so then will that pit be of any value to the organization? No. Okay, so that no matter how deep that is, but that's of no value, because the entire the product has been derived from it, the entire content has been taken out. So they are called the wasting assets. That means they will lose their value once the contents are fully out of it. Intangible assets, that means only those assets which you can't touch, see, feel. They are called intangible assets. So like your debtors are your intangible assets. You can't see that. Goodwill is your intangible asset. Okay, so they are intangible. They remain, they have their value, but they don't exist. Fictitious assets are the valueless assets, but shown as an asset in the financial statement. Okay, so like your I'm sorry. So fictitious assets, they are the assets which they exist in your balance sheet, and they will otherwise have no asset use. So like your any sort of your trademarks that are there, any patents that you have applied, they are your assets. They are your asset, but they are treated as assets, but they do not have any what I may say, but they do not have any cash value to that. Liabilities are obviously claims against assets. That means if I dissolve an organization, if I dissolve a business right now, so there will be certain set of people who would claim their share on the assets. So they, whatever is payable to them, that is the liability. The existing debt and the obligations, they are the liabilities. Liabilities are categorized as of two types: current and non-current liabilities, the long-term and the short-term liabilities. So both long-term and short-term liabilities are the liabilities which have to be paid off in the near future. Current means they have to be paid in less than a year, and non-current means probably some little bit more than a year, but definitely not beyond that, not beyond 2 or 3 years. Long-term will means whichever lifespan of more than 3-4 years of this payment term. Fixed and long-term liabilities, they are the liabilities which are payable on the termination of a business, such as capital of the proprietor. So they are fixed or long-term liability. That means equity, the capital of the business will only be paid once the entire business has been winded off. It has been terminated, the entire business operations. Only then it has to be paid. So they become the fixed or the long-term liabilities. Current liabilities are those liabilities which have to be redeemed in the very, very near future, and long terms are which are not very near future but have to be paid. Non-current liabilities. Contingent are those liabilities. Contingent liabilities are those liabilities which are to be paid upon happening of a certain event. Okay, so let's suppose there is a lawsuit. If there is a lawsuit, there are two parties involved. Either of a party, if they lose, they have to pay off certain amount. They have to pay certain amount. So in that scenario, that amount, that value that they have to pay off, if they lose the case, that becomes the contingent liability. That means if at all they lose, the event is losing that court case. If at all they lose that case, will they have to pay, this liability will arrive. Otherwise, if they win, that then it may convert into some other picture for them. that may not come. So this is the contingent liability. They are not actual liabilities, but they're becoming actual liabilities depend upon happening of a certain event. If such events do not occur, no liability is incurred. If they do not lose a case, if a party does not lose a case, then it will then this sort of a liability will not be incurred. Then it will not happen at all. So difference between assets and liabilities. By the general meaning, an asset is something which is individual or which a company owns, company or an individual owns. Liability which an individual or a company owes. So business meaning, assets are those objects which are owned by the company, having monetary value, immaterial or of tangible or intangible. Liabilities are the debt or the responsibility of or an obligation owed by the company having the monetary value. Type of assets, current assets, non-current assets. Type of liabilities, current liabilities and non-current liabilities. Calculation of assets is equal to liabilities and owner's equity. Liabilities are, on the other hand, this calculation has been derived from the equation only, accounting equation only. Liabilities is equal to assets minus owner's equity. Examples on assets are building, cash, goodwill. These are the assets. And liabilities are borrowings, ODs, bank overdrafts, accounts payable, etc. This is the statement of owner's equity. On the screen, so if you can see in this statement, this is for, this is a sample format for the statement of change in owner equity. So it shows a balance on the January 1st of a particular year. Then it was, in the first column, it shows the common stock. That means the stock that has been applied for. And then the paid in capital in excess of the par value. Par value means the base value of the share, which in this particular case is $1. Then the retained earnings. Retained earning means the profit that the business has incurred over the lifespan. Then the stock, that means whatever has been invested. And then comes the final, that the final answer is the total shareholders equity. So balance as on the 1st January of a particular year is, that means they have invested on 20 lakh shares at $1. So the 20 lakhs was the base price. They have paid in excess 25 lakhs. That means shares were issued at a premium. So 20 lakhs is the base price, 25 lakhs is the premium. Over the period of time, till 1st January of that particular year, they had earned the profits of 11 lakhs, and they had already invested in the treasury stock of 50 lakhs. So that way, the owner equity, total shareholders equity on the 1st January was, I'm sorry, this is 5 crores 10 lakhs, 5 crore 10 lakhs. Now during the year, they have issued the shares for cash. Okay, so they have issued the shares for cash. For 30 lakhs shares they have invested further, and they have paid an excess capital of 12 lakhs to acquire that, 1 crore 20 lakhs to acquire those shares. Then additional investment has been made to in the treasury stock. So the net income, that means the net profits that for particular period was 40 lakhs, that has come in under the column of retained earnings. Cash dividends that have been earned is 15 lakhs paid, and the stock dividends have been paid as 57 lakhs for on the retained earnings and the capital. So likewise, on December 31 for that particular year, the statement of equity showed that the total amount has changed from 5 crore 10 lakhs to 6 crore 60, has increased from 5 crore 10 lakhs to 6 crore 65 lakhs during a particular year. That means the owner's value in the business has increased. So this statement summarizes the changes in the owner's equity for the specific period of time due to the contribution, withdrawals, and the net income or losses. Okay. So if the owner contribution and income will go up, that means a business has earned profit. And if there are withdrawals and expenses, if there are losses and withdrawals, then this will go further down. So owner's equity, like we have, like has been explained earlier, owner's equity is equal to total assets minus total liabilities. Owner equity has four portions. One is capital, that means the original amount invested. Drawings means any amount which they have withdrawn from the business. Further, any revenue if they have, earned, and any expenses if they have, if there have been any losses. Revenues means any profits, and the expenses mean any losses if they have incurred. So whenever the assets are more than liabilities in a business, that means a business's net worth is positive. That means the owner's equity has increased over the period of time, hence the net worth of the business is positive. Net worth of business, net worth of doing business is positive. Okay, so now there are few items which I will there are few items on your screen. Can you please categorize them as your accounts payable, inventory? Where will they appear? Asset, liability, or equity? So accounts payable, where will that appear? Is that asset, liability, or an equity?
Liability.
True. Inventory, asset, liability, or equity?
Asset.
Assets.
Common stock, asset, liability, equity.
Equity.
True.
Equipment assets.
Asset.
Accounts receivable,
Asset.
Asset.
wages payable,
Asset.
Liability.
Sorry.
Liability.
It's a P&L item.
it's a liability, it's payable, it's not paid. It's not wage expense, it's wage payable. Buildings,
Asset.
Asset.
Assets.
retained earnings,
Equity.
Equity.
loans
Assets
payable.
account.
I'm sorry, who's saying assets?
Liability.
Loans payable is a liability.
Liability.
Equity.
Yes, yes,
Cash
yes.
is what?
Liquid asset.
Assets.
Is an asset. True. Cash is asset. Let's move on to the next financial statement, which is profit and loss account. Where total revenue reduce if total revenue
Liability.
sorry
Asset.
I
Asset.
think there is some latency in the network with you, Snigdha. You still on this slide, on the quiz slide?
Hello.
Hello. Okay. So we were discussing the next financial statement, which is income statement, profit and loss statement, which is that means where revenue minus expense, if it is a positive figure, will give a rise to the situation, which is profit. So in this picture, in this sheet that is slide in which is in front of you, the top line is the revenue. The top of the statement shows the revenue here. Okay, and the bottom shows the one marked in the red shows the expenses, and the last, which is the highlighted one, shows the net profit. That means the total of all the revenue minus the expenses will give the answer as a net profit or loss. The objective of profit and loss account is to point out the progress registered by the company. So profit and loss, obviously it mentions the what is the progress during the particular year, from a company's operations perspective. So what is the objective of preparing a P&L account? It gives an idea on the net income of the total sales and gives the idea of what has been the earning per share for the running the business operation. Discloses information about the revenues and the expenses that are direct result of business operation. Profit and loss account. The profit and loss account, this we have discussed. The revenue minus expenses. If the answer is positive number, that means revenues are greater than expenses, the resulting answer will be positive. That positive figure shows profit. If the revenues are less than your expenses, that means resulting answer is a negative number. Negative number means losses. The profit or loss, whatever a business earns in a particular year, is carried forward and as a retained earning. Positive number or a negative number, whatever it is carried forward to the retained earning in the balance sheet. So if there are expenses, if there are revenues and expenses, they are not directly posted in the balance sheet. They are posted first of income and expenditure statement is prepared, and then after that, the final number, which is the profit or a loss, then it is carried to the profit and to the balance sheet, and hence results in the change in the owner's equity, right? Because it will be carried forward as a retained earning, and retained earning will affect the statement of owner's equity. please go through this profit and loss account, which is on the screen. And if you have any questions on this, you may please ask. Please go through this. I hope everybody is able to, see this. I'll give you 2 minutes to read it through and ask any questions if you have. Please read through, otherwise I will ask you a question and you will have to give an answer. So no questions? Everything is clear in this profit and loss account? Okay. So what is return inwards?
This profit and loss account include trading account as well.
Yes. Right. That means the sales that have been returned back to us. Okay. Likewise, return outwards means the purchases which we had made but have now returned back. Okay. So my next question is that after net purchases, why there is a line item saying less closing stock?
So whatever purchase we have done for that year, and the closing stock is remaining, so we have that much in inventory, maybe in our stock. That's why we have reduced it.
So
And we want to
why
show
have
the
we reduced it? We have made expense to we have made an expense to purchase in the current year only. Why it is not appearing as full in the profit and loss account? Purchase has been made in current year only, no?
correct. But the closing stock will be there, correct? So it will go for the next year
Right.
because that has
So
not
closing
been
stock
sold.
is exactly. So closing stock is the balance sheet item. It is inventory.
Yeah.
It cannot appear, it cannot be part of the purchases also here, and it cannot be, otherwise they will make a double impact in the P&L and the balance sheet. So hence the closing stock has to be reduced from here. Okay, that's a right answer. So I hope this is clear to everyone, right?
Yes.
Okay. So profits result in increase in the assets. That means either through cash or the receivables, whatever ways. Okay. And liabilities, through liabilities. And profits will result in increase in liabilities because the retained earning will also go up. The owner's share in the business will also go up. So likewise, if there is a profit, it will get posted two ways. One way, it will either, increase my cash, or it will increase my trade receivables. And on the right hand side, in the balance sheet side, liability side, it will increase the owner's equity. Okay, likewise, if there are losses, it will either result in the loss of cash, or it will result in the increase in the liabilities, that means payable for me. Likewise, it will result in decrease in the owner's equity. So that way the balance sheet will always remain balanced or equal on the both sides. Okay. Moving to the next financial statement, which is a cash flow statement. So like we had discussed, that cash profits may not be necessarily equal to the accounting profits, right? So we had discussed that a business may be doing very good, maybe showing very positive pictures in their financial statements of balance sheet and profit and loss account, but actually the cash position may differ. So that means the cash profits are different than the accounting profits. You've accounted for the revenue, accrued revenue, but that revenue has not been realized. It is appearing as a receivable in your balance sheet. Hence, it's a which is a non-cash item. So your cash profits are very different from your cash profitability is very different from your accounting profitability. Can you please think of any other situation where your cash profits and accounting profits will differ? Do you think it's a common situation in every business, or do you think there's a situation where cash, or I should ask the question in another way, I should ask, can you think of a position where cash and the accounting profits will be equal? Where will that be? Can you think of any business proposition where your cash and accounting profits will be equal? Well, truly speaking, I can't think of, apart from, the small businesses of, you may say, where there's a cab running and you just, immediately get the money out when you drop off the customer. That's the real time where your profits get realized. I don't think there's any business. The very small businesses, I'm not categorizing that, but in the large businesses, there is no proposition where I cannot think of a proposition where accounting profits and cash profits will equate. So I think it's a rather common, then that means that's a common, situation where accounting and cash profits differ. So when we say it is in cash profits only, cash basis accounting only, I can say, where the basis of accounting is cash basis, where your accounting profits and your cash profits will equate. So in accrual method of accounting, this I don't think is a real phenomena where your cash and the accounting profits at any given point can equate. So income statements in the annual report will never be equal to the company's cash position. So this is one of that examples only which I had, quoted earlier, where company gets a major contract and revenue is, revenue is due to accrue in, 4 different phases: revenue 1, 2, 3, and 4. That means money is not yet received for, the entire contract. So company is earning profit on the income statement. Exactly, because year on year, there is a revenue which company is earning as per the contract. But since cash is not received, there is no actually cash profit. So cash flow statement, that means a cash flow statement is a very, very critical tool to analyze that what a company is saying is actually happening, because at the end of the day, whatever you may show on your financial position, if you do not have the money, to back that up, your position is very, very delicate. It's seen as delicate. It's similar to what Mr. Ramalinga Raju had done with Satyam. He inflated his receivables, his businesses receivable by making fake invoices and receipts. Actually, cash would have never come. So his financials may look very promising and very, very bright, but actually the cash flow position, if somebody would have seen, cash flow would have been really, really delicate. So it was the cash flow that could have, brought the tiger. So his statement, Mr. Ramalinga Raju's statement is that I am riding on a tiger and I don't know how to get off that tiger without being eaten. Exactly, it's the position. So cash flow statement takes into account all the cash flows in the company, the cash inflows when company makes a sale, cash outflow when the company pays dividend or purchases shares, or cash outflow when company purchases a new property or land, or cash outflow when company incurs any expenses and pays off its creditors. That this is where the entire this is the entire inflow and outflow that accounting is called cash flow, gives rise to a statement called cash flow. Cash flow divides the entire business operations into three parts. The revenue, cash flow from operations, cash flow from financing activities, and cash flow from investment activities. That means whatever has been cash flow from operations, that means the main core business of the organization. That means if it is into the manufacturing and selling of cars, then the company operations operational cash flow will be counted, will consist of the revenue from selling of the car and the cost of manufacturing the car. So any outflow which is directly related to car manufacturing will become its will become part of its operating cash flow from operations, and any revenue that is being generated by selling of the cars will become the revenue from will also become the part of the cash flow from the operations. Now, financing activities, the cash flow from the financing activities, if the company has debts, if the company has loans to repay, so the company is paying interest. So whatever cash flow, negative or positive, the company is having from the financing part, if any increase or decrease in the cash balance from the financial part of the company, that means loan repayments and interest repayment, that will become the cash flow from the financing operations. And investment means if companies activities, that means net income. So how does it happen? Is like if there is a sale which is non-cash based, that means which is on credit, so then you receive your receivables from your net income. So like if a company says that I have made what should I say? I have made the sales of 100 crores in this particular years. Out of this 100 crores, if it says out of this 100 crores, my 30 crores were the sales on credit. So then actually, as per cash flow statement, your revenue, your sales will be counted as 100 minus 30, which is 70 crores only. Likewise, if they say I have made an expenses of 70 crores, and out of those 70 crores, if they have only actually paid 50 crores, so they were going to add back those 20 crores which are yet payable and not have been paid. They will add back into their income. They will say, no, you've not paid 70 crores. You've rather paid only, you've only expensed off only 50 crores. So all non-cash items are added back or reduced. Non-cash liabilities are added back and non-cash assets are reduced. So any investment on the plant property and the fixed asset is called the capital expenditure. This we had discussed earlier. So now, while making any, for an investor to make any sort of a decision, whether to invest in the business or not, they only see that if a cash flow is looking promising from the operation, because operations are the core of a business. So if operational cash flow is promising, so that is a real brownie area or a business brownie area for the business to earn the points there. So that becomes the major highlight points for any investor to see the cash flow from the operating activities for a particular business. Cash flow statement, financing. The last business activity detailed on the. So cash flow statement on the sorry, the cash flow from the financing activities, it provides the business activities and the cash flow that results from the financing part of the business. It's an overview of the cash which is used in the business from financing. Investors they use this financing cash flow to find out that how much have been invested in the business on the on the debt, how much debt has been utilized in the business, and how much are the investors able to gain out of the business. What has been the return on their investment in the business. So it also includes the cash obtained or paid from the capital fundraising efforts of a business. That means if a business is raising additional capital, if a business is raising additional equity or a debt, so that also forms part of the financing cash flow. So income statement of SoftBite is there on your screen. It shows the service revenue of 4,700. Against that, the expenses are there, which is salary, rent, advertising, and utility expenses. Then total expenses are amounting to 1,950. That means net income is 2,750 rupees. So this we have discussed that this 2,750 rupees will be added back to the owner's equity in the balance sheet. So financial statements, we have discussed that there are various ways to present the financial statement. The single step versus multi-step financial statement. Single step financial statement is a financial statement which will summarize all sort of revenues, then all sort of expenses, and in the bottom it will give you the net profit. That means profit matrix will be only used once. Okay. Whereas in the multi-step financial statement, if you can see on your screen, it will give you the profit matrix on every step. That means if revenue minus cost, total, it will give things. It will give you the net profit and similarly PAT after that. So various ways of presentable steps, financial statement into the categories of cost. That means you can categorize, this is my revenue from probably this is my total revenue, and this is my other income. Then on the expenses, you can give the various head of expenses, and you can continue calculating your profit. When the cost center approach arises, on the cost center approach, you will calculate the revenue and the expenses from each of the particular, each of the individual categories of the business. Like revenue, if they are dealing with multiple, line of businesses, then revenue from first line of business, second line of business, third line of business. Accordingly, your expenses on various line of businesses and cost center wise, that means your expenses, and then your profits accordingly. This we have discussed, that owner's equity is shown as a liability in the balance sheet. Transaction analysis. So before we move on to transaction analysis, let's have another 15 minutes break, and let's catch up at 3:15. All right. Hello everyone and welcome back. So next, let's move on to certain transaction analysis, wherein we will recap, what we have done until now. All right. So we'll be talking about a particular, test case wherein Mr. Narendran decides to open a computer programming services, which is SoftByte, and there's a bank. Okay. So now let's quickly get into a brainstorming session and understand that where will it have the transactions that I'm going to pop out to you will have an impact. So on 1st September, Mr. Narendran invests 15,000 cash in the business, which he names as SoftByte. What sort of accounting entry will it generate, and where all it will have an impact according to you? I hope everyone is back and we are on track. We have few more slides to cover, and your quick answers will contribute to timely finishing this already long session. Yes, I'm waiting for your answer. Mr. Narendran, invest 15,000 cash in the business. What will be the accounting entry for this?
Cash account debit to capital account.
Right. So like we can see in this, he invests 15,000. So assets and liabilities, if we have plotted on the screen, if you can see. So assets, cash will get debited by 15,000, and on the owner's equity side, capital will get increased by 15,000. In the next situation, the SoftByte purchases computer equipment for 7,000 rupees cash. What will and where will it impact on the balance sheet?
Computer account debit to cash. So decrease in cash and increase in assets.
So true, very right. So like it is mentioned, it is depicted here, the cash will go down by 7,000, but on the asset side, the equipment, that is computer, will get added by 7,000. Hence, your assets and liabilities will remain equal in this particular scenario also. Let's move on to the next scenario where SoftByte purchases computer paper and supplies expected to last several months from ABC Supply Company for 1,600 on account. On account means on credit. Okay, so now since these are supplies which are expected to last several months, this will become my inventory. So my supplies will get added by 1,600 rupees, and since this is all credit, that means I have to pay amount later, it will be added on as an accounts payable in my liabilities. So assets and liabilities hence will remain equal in this scenario like this. So my inventory account debit to my creditors. Next, SoftBite receives 1200 cash from the customers for programming services it has provided. So since it is cash that has been received, that means asset side, my cash and bank balance will go up by 1200 as it has been depicted here. And likewise, since it is the revenue which I have earned, it will add to the owner's equity here. Okay. Assuming that there is no other expense of whatever, so this is the only profit, this 1200 will get added here. Next, SoftBite receives a bill of rupees 250 for advertising its business but pays the bills on a later date. So it receives a bill to be paid later. That means this bill is my expense. I had to pay it later. If I have to pay it later, that means I have increased my liability. Liability here is added by 250, and since it was an expense, it has to be reduced by the profit that I had earned. That the owner's capital it has to reduce. So 250 rupees has been reduced from the capital. SoftBite provides programming services for 3,500 for customers and receives cash of rupees 1,500 with the balance payable on account. That means 3,500, it has made a sale of 3,500, out of which only 1,500 has been received as cash. So cash account debit 1,500, balance 35 out of 2,000 out of 3,500 will become my debtor. That means my account receivable. Likewise, it was a sale, it was a revenue, it will be added back to the owner's capital. Next, expenses paid in cash for September are the store rent 600 rupees, salaries of employees 900, and utilities 200. So impact is reduction in the cash and likewise reduction in the owner's equity. I hope everyone is clear till now, and there's no confusion on the treatment of any of the transaction that we are discussing. If there are, please stop me and please you can have a clarity here. Shall we move ahead? Thank you, Kaushik. Thank you, Sushant. SoftBite pays it advertising bill of rupees 250 in cash. Since it has been paid in cash, 250 has been reduced by cash, and since it was a bill that was earlier, unpaid, and it was the liability has further reduced. Now this 250 has been reduced from the liability. Sum of rupees 600 in cash is received from the customer who has been previously billed. So if that means my debtors have now paid me money, so 600 rupees, my debtors will go down by 600 and my cash will go up by 600. Now the owner withdraws 1,300 in cash from the business for his personal use. So now what will happen? Cash will reduce by 1,300, and likewise due to the drawings, his capital will also reduce by 1,300. So while analyzing the relationship in the transaction, like we have analyzed it earlier, there are a few more examples, like XYZ buys a building of 70 lakhs, pays in cash. So now what will happen? Building will get added by 70 lakhs. Here the amount is shown in millions here. So 7 millions added here, and cash, you can see negative mark on the top column. So cash getting reduced in the negative column by 7 million, and the buildings get it added by the 7 million in the asset side, right? buys parts for assembly at a cost of 2 crore 70 lakhs, sale on credit. Actual payment will take place at a later date. So now, since this is part for assembly and this is an inventory, so my inventory will get added by 27 million here. And since it has to be paid on a later date, so likewise my accounts payable, that means my creditors will get added on by 27 million in the liability side. Hence, my total in the balance sheet will remain equal at all the time. This is what we're trying to depict, that for any sort of a transaction, impact on the balance sheet remains equal on both the sides. Assets and liabilities will remain equal. XYZ raises 15 million of fresh equity. So 15 million of fresh equity will add to my cash balances, and likewise the owner's fund, the common stock, will increase by 15 million. XYZ sell one of its building at 11 million. Book value was 7 million. So the assets will reduce by 7 million since it has earned profit of 4 million, because the asset was worth 7 million and has been sold for 11 million. So I have actually, how much cash have I got? I have got 11 million. So I will increase my bank cash balance by 11 million, but actual asset cost, which was recorded in books, was 7 million. So my assets will get reduced by 7 million. Whatever was the profit on the sale of this asset will be added back where? It will be added to the owner's equity, owner's fund, which is retained earnings, because it is profit. Is this clear? Is this understood to everyone? Moving on next. XYZ pays monthly payroll of 8 million. So payroll is an expense. Expense will get expense will reduce my cash balances, and likewise my wage payable will get reduced. That means it has to be paid, and now my payable has gone down. XYZ sells goods of values 15 million. These goods are of 9 million to the manufacturer. Okay, so that means the cost of inventory in the books was 9 million. So inventory will reduce by 9 million, but it has sold goods. It has sold goods. So my receivables will increase by 15 million. The profit which has accrued, which has not been realized yet, it is not yet cash. So that profit, accrued profit, will add back to the retained earnings. So now, after all this, what does my final balance sheet look like? XYZ Limited sells good of 15 million. These goods are 9 million. So this is what my final balance sheets now look like. So the closing, the balances at the end of the period after all these transactions have been recorded, the balances of the individual accounts reflects like this. Building stand at 40, equipment 32, cash balance is 79, receivable, and hence total assets amounting to 412 million. And likewise liabilities, and there has been increase in the retained earnings, that means which is the owner's equity, and this has also resulted, so the liability side also remain equal to 412. So assets and liabilities remain same after all sort of transactions have been entertained in the business. So like we have seen on the previous examples, the statements in the cash flow, the profits in the accounting and the profits in the cash are absolutely different. So what are the methods of preparing a cash flow? Cash flow can be prepared by using two methods, direct and indirect. Direct method of preparing it is that you please take the entire cash and bank book. And with the cash and bank book, you start summarizing whatever inflow you have into the various sort of activities, operating, financing, and investing. And you, you bifurcate your cash inflow and outflow and categorize, and you derive your cash flow. And indirect means that you get it from the financial statements itself. That means any reduction, any non-cash items are added and reduced back to the bank balances, and any only cash items are any increase and decrease in cash is only considered for making the cash flow. So each component of cash statement is derived using balance sheet and income statement in an indirect method. And most companies, this is mostly used method. Indirect method is the most widely used method for preparing the cash flow. Moving on to the next. This is the Hindalco's balance sheet for 31st March 2017. As you can see that this balance sheet represents the assets and non-current assets first, and then the current assets. So there are, and it shows the comparative of the last 3 years. That means it has been prepared using which accounting methodology? Which accounting methodology prepares the comparative, uses the comparative of last 3 years? We have just read in the, previous slides. If anybody can recall, right? GAAP. So that means this has been prepared using GAAP. So you can, very, very quickly analyze that, what accounting methodologies, what accounting methods have been used for preparing, what accounting rules have been used to prepare this financial statement, any financial statement. Okay, so it presents the non-current assets first and then the current assets. So likewise, non-current, that means your fixed assets, mainly your property, plant and equipment, capital work in progress, your intangible assets, they are all showing the moving balances as on particular day. That means with this balance sheet, you can analyze how the asset side of the business is growing or moving. It was, 2016, it was at 56,000 million, and now it is at 56,732 million. So there has been an increase in the non-current assets. Current assets, how will you read it? Current, likewise, there are the various components of the current assets, and which also show an increasing trend from 24,260 million to 29,508 million. So likewise, the total assets, we can safely say that they have increased. Equity and liability, so you can see that there is a movement in the shareholders fund, there is movement in the equity. You can see the shareholders money has increased from 42,159 to 47,332. So what you can make, we can easily make that there has been either one, there has been an additional equity either which has been brought into the business, or the business has earned profits during the current financial year. So we have to, so while this is the summary of the entire financial picture, but for details we will have to see that how this equity has increased, if this has been profit of the organization that has made this go up, profit of the operation from the running business, or it is the introduction of the fresh equity that has led to the increase here. So likewise, we can see non-current and the current liabilities being listed. We can see a decreasing trend in the liabilities, in the current non-current liabilities, but on the other side, that current liabilities have increased. Increasing of current liabilities here, I can analyze and I can say that means the business operations have expanded, due to which the current liabilities of business is increasing. Coming down to the profit and loss statement for the similar period for Hindalco. It shows income from operations. Just a second. Okay, so from income perspective, we can see that income from operations, the revenue from operations has also increased from 36,713 to 39,000, and the other income has shown a minor increase. So that ways the operations have expanded for Hindalco and the sales have increased. Similarly, expenses also showing increasing trend. So while when both are increasing, it only shows the growth in the business. Would you agree with this? Can there be any other interpretation while looking at the expenses and the balance sheet of this organization? I can only interpret that the organization's business are expanding, and hence there is an increase and there is a positive trend in all the numbers, and numbers are increasing, and their growth is being witnessed in this balance sheet. I can quickly analyze, and we can quickly have that look, and have this first impression that Hindalco's operations have been profitable. Like, right? Would you agree with this?
Hello, can you please repeat the statement, what you said, like how to see? Actually, your voice was not audible. Sorry for that.
Okay, so I'm mentioning, see, since the assets are also going up, the balances in the revenues from operations is also going up. Similarly, expenses have also gone up, but that can be related to the operations. Since the business operations will expand, the both of the things will shoot up. Positive side is that the only current liabilities are increasing and non-current liabilities are reducing. That means the current liabilities and current assets relate to the operating cycle of the business. That means the operationally this organization is expanding. This is where we can analyze that Hindalco would have been largely profitable and largely good business, had a good business in the financial year 16-17, for which the financials are presented in 31st March 2017.
Neha, hello.
Yeah.
Okay, can you tell me what are things covered under power and fuel? Because with respect to 16 to 17, there is a reduction. So what actually is this head consist of?
Where are you looking at this power and fuel, if I may ask you?
Expenses.
Okay,
Under
power and fuel will relate to the electricity sort of an expenses here.
So how come? I mean, just a out of box question. Just how come it is reducing when they are expanding?
It could be, so for a number of reasons. One could have been, adopting some energy efficient ways of doing business. Okay, so there could be a number of things.
Okay.
So this is where a business expert, for particular, so anybody cannot answer the specifics of a business while only looking at. So this is the clear-cut example. I do not know Hindalco's business in detail here. Okay, I do not know the fabric of the business there. So I cannot answer each and every detail. This is where we discuss that the financial statements give the macro view. They, for every nitty-gritty, for every detailed aspect, for any detailed question, you have to dig down deeper, okay, into the business operations. Any questions here, or should we move next? Okay, so coming down to the cash flow, you can see this cash flow has been prepared with the indirect method because there has been adjustments. They will say that they had begun from profit before tax, which is reflecting here. 2152. Okay, so after that there is an adjustment. Depreciation is being added back because it is a non-cash item. Depreciation. Employee stock option scheme, this is again being added back because this is an option, this is not an expense which they have incurred. So all these expenses will be added, all these will be added back, and the cash reductions where they would have unrealized gain or loss, like if we are talking unrealized foreign exchange loss. So they have realized a loss of 40.77. This will get reduced. This is a cash loss. That means they had accounted for a transaction on let's say some X rupees, but they have to pay, if they are paying it on later date, and probably there is currency fluctuation that has led to an increase there on the payment side. So all these adjustments will make their way in their cash flow. So at the end of the day, when their cash profits, if we are looking at net cash generated from the net cash generated is 5897. I will just see that if there is any other. Okay, so you will here see that while the profit, we began from 2000 some number 2152, we began from there, but actual cash profits that they have earned during the period has increased to 4,307 rupees. That means if they would have done a cash basis accounting, they would have posted a profit of 4,307 million rupees here. Now, let's quickly move to a question. This is the question for you all. With all these facts which are there on the screen, please try and build a balance sheet and give me what is the total assets and liabilities that you arrive in your balance sheet. You are all requested to please attempt this question and build a balance sheet. We can have 5-7 minutes, whatever you require to make this balance sheet. Please Yes. Any answers yet? Anybody has been able to solve this? Okay. Khushbu says 5 more minutes. Quickly, we have another small set of questions before we wrap up this session. So I would request people to please quickly attempt this, try and attempt this. No worries. I'm here to clarify your doubts. If any doubts you have, you can raise, please. Nobody else? Nobody has been able to do it?
I'm done.
Very nice. So what's your balance sheet total, sir?
Then balance sheet total is 12,355.
12,355.
Yeah.
Okay.
I have done it, and my total is 15,595, and balance is 5,595.
So this is how your balance sheet will look. So 12,355 is the right answer.
Yes, ma'am.
Yes. So I don't know whose answer was who was speaking last. I don't know. I'm
Shiva.
sorry.
I'm Shiva
Yes,
this side.
Shiva, your answers right. So for anyone if I may repeat, the question, and if we try and attempt and give you the clarity here. So okay. So Mehur Furniture Proprietor subscribes 10,000, which is paid into the company's bank account. So if we will analyze this transaction, it will add 10,000 to the cash account here. If you can see, there is a breakup of the entire transaction here when on the formula bar. Is this visible to everyone? So bank will get added by 10,000, and likewise the equity will be added by 10,000 rupees. In exchange, Mehur issues 10,000 unit of common share at 1 rupees each. This is nothing but the first transaction only. Mehur manager decides to buy a truck for 3,600. So when he buys a truck for 3,600, 3,600 of truck is added here, and likewise this 3,600 gets deducted from the bank account. Manager decides organization needs a computer and buys the second-hand one for 240 rupees. So again, when he will buy a computer for 240 rupees, his computer will get added by 240 and the bank balance will further reduce by 240 rupees. They buy 10 wooden chairs for 150 each. Intent is to restore the chairs and sell at profit. If the intent is to restore and sell at profit, that means it is an inventory. So inventory of chairs, 150 rupees for 10 chairs. It was initially 1500. Then they subsequently they sold. So then if 1500 they have bought, 1500 is paid out of cash here and the inventory is added in the inventory. He sells one chair at the profit of at rupees 400. When he sells one at 400, the 400 rupees gets added back to the bank account. Chair, the cost of one chair was 150. So one chair gets reduced here and the earnings get affected. The profit gets added to the retained earnings. He sells another chairs at 405. Similar treatment, 405 gets added here and sorry, he sells it on the credit terms. 405 will get added as a trade receivable and the inventory will get reduced. Buys two antique tables at 1000 each on credit. So when he buys antique tables, 2 for 2000, so 2000 ki inventory gets added here and the bank account gets, trade receivable, trade payables get created for 2000 rupees. He sells another chair for 400 rupees and customer pays by check. So 400 rupees gets added back to the bank account and the inventory in the chairs get reduced by further one. Profit on the sale is added back to the inventory. Retained earnings. He sells the table for 1800 and customer pays on credit. So whenever the customer pays on credit, that means accounts receivable get affected here. And the inventory of tables get reduced by 1000 rupees. Profit on earning, profit on the selling table is added to retained earnings. He receives checks for 405, which he has sold earlier as a credit. So his 405 is added to the bank account here and the trade receivable gets reduced by 405. He pays their sales assistant their first salary of 1200 in cash. So since salary is an expense, 1200 will get reduced by the retained earnings here and the bank will get reduced by 1200. The answer would be the total assets was 12,355 and liability balance sheet size is 12,355. His business has increased the value by 2,355 by investing 10,000 in the business. He is now, his business size has grown to 12,355 now. Is this clear to everyone? So let's look at these questions. Which of the following statements is true? The balance sheet typically shows net realizable value of all entities' assets. Balance sheets of highly profitable companies will always have a healthy cash balance, and or in the cash flow statement, depreciation is added back to the profit figure. Which out of the three statements is true? Right, correct answer is C. Next, true or false? Withdrawal of funds by the owner of the business has no effect on the equity figure in the business's financial statements. True or false? Correct. Which of the following is a fixed asset for a shoe manufacturer? Inventory, plant and machinery, cash, account receivable, or long-term debt? D is the wrong answer. B, plant and machinery is the right answer. Inventory is a short term, is a current asset. An organization has cash of 11,000, accounts payable of rupees 25,000, and long-term liability of 80,000, and owns land worth 1,60,000. What is the stockholders' equity? What is the amount of equity? What is the value of equity here? That's the correct answer, Pallavi. $66,000 is the correct answer. So total assets means 11,000 cash plus 1,60,000 of land. That means 1,71,000. Then total liabilities, that means 25,000 of liabilities long term and 25,000 of account payable and 80,000 of the long-term liability, which adds up to 1,05,000. Assets minus liability, 1,71,000 minus 1,05,000, which is 66,000 is the owner's equity. Which of the following best describes the purpose of a balance sheet? It is a clear and definite estimate of what an organization is really worth. It is the amount that the organization could be sold for in liquidation. It is an amount that the organization could be sold for as an going concern. It comprises of the assets of the organization and the claims against those assets. A is not the right answer. D is the correct answer. No, B is not the correct answer. So option D is the correct. It comprises the assets of the organization and the claim against those assets. Capital expenditure will have an immediate impact on the following statement: income, balance sheet, both of the above, neither of the above. True that. It is B only. So the last question: which of the following accounting concepts dictate that the liability and losses should be anticipated, but income and gains left unanticipated? True. Correct. Prudence is the answer. So with this, we wind up our session for today. Thank you all. Look forward for your feedback. Hope you've got the clarity and hope you have all your doubts are clear. Any questions there? I am here to answer in the next 5 minutes. Otherwise, we'll wind the session up. Thank you, everyone.
Ma'am, can you please share this presentation with us?
Yes, I will shortly share it with Karan here, and you can have this from him.
Sure. Thank you, ma'am.
Yeah.